Hello, this is Michael Moriarty, Chief Investment Officer at Wellspire. We are on location here in sunny Orlando. This is our semi-annual market update. As always, I'm joined by Chief Market Strategist Chris Maxey and Deputy CIO Dimitri Katz-Nelson. Chris, as our Chief Market Strategist, 2024 was an interesting year.
Yeah, it certainly was. So we had a back-to-back situation where equity markets were up over 20%. And in fact, the S&P finished up 25% last year. It's the first time we've seen that back-to-back outcome since the late 90s. And I think a lot of people were surprised. You know, the thing that we've talked about is that the Federal Reserve started to take their foot off that gas pedal and finally began to ease up. Do you think that was the biggest reason as to why markets did so well?
Well, I think that to me is one of the most important data points as we head into 2025, with most people thinking beginning of a Fed cutting cycle, which began in September of 2024. Most people think rates fall. Well, rates, of course, at the short end, which is what the Fed controls, did fall as expected. But rates on the longer end, in fact, raced higher in full 100 basis points, 1 percentage point by the end of the year. I think that left a lot of people scratching their heads.
Right. And that was the one thing that was a little bit confusing about last year. Equity markets did so well, but as you start looking at the spectrum of other asset classes, particularly after the election, things changed. We saw that overseas international equities didn't do as well. Fixed income yields started going higher, as you mentioned, which when the Fed is cutting, you don't expect that interest rates are going to go up. And yet here we are, that's exactly what took place. So I guess that now sets the stage for 25 and what we might be thinking about. What comes next?
I think a lot of the questions we're getting is, one, the election, inflation, Fed. So just address them sequentially. I mean, election-wise, it's still early. We're obviously picking through, the latest guidance. By the time this video comes out, we'll probably have a bit more to chew on. But the tax agenda is still to be decided. But we are seeing something interesting in that everyone's really focused federally. There's actually some things happening at the state level which may change things. So we're definitely going to push clients in an election change year, especially when tax is a core issue that's discussed. So this is the time to have those financial planning discussions on that front for sure. On the inflation side, there's concerns about potentially higher inflation, but markets are only pricing 2.5 still, which in part is I think just looking at people not being categorically sure of where those things are going. But I think part of it is also just, we've seen this, right? There's concerns about tariffs and goods inflation. Well, goods are still probably about a third of what we spend our money on. It's less than that. Services are a much bigger piece. So there's been analytics done of saying even if it's a 10% universal tariff, it may not be as tangibly material as it would have been in the 1970s.
I think it's a great point. So said tongue-in-cheek, tariffs could impact the price of that new refrigerator you're buying. Tariffs are not in and of itself going to impact the cost of that dinner you take your family out to enjoy.
Absolutely.
But one of the things we discussed, and it's been part of the conversation these last few weeks, is that there are a lot of uncertainties. So range of outcomes from top to bottom is probably a lot wider now than it was presumed to be 9 or 12 months ago. And that's just because there's so many policy things coming that we really don't have exact clarity on. Even as you think about tariffs, it was assumed, okay, we have these first day tariffs that will be taking place relative to China or Mexico or Canada or any other number of countries. And then we came to find out tariffs didn't happen on day one, right? They were delayed. Now the numbers look like they're going to be smaller than what was believed. So I think this is an evolving process, but we do remind people those outcomes are going to be wider now.
I think that's well said, and your language is purposeful, and that the upside surprise is that much wider as well. We don't know. We may get, in fact, generational reductions of regulatory burden and the like, which may be very positive to the economy, very positive to earnings, very positive to the market. But as you rightly said, that downside set of scenarios certainly
it stays there.
Well. Yes,
yeah. It hasn't gone away.
Right. I think we talked about the Fed. I think we are in the camp that I think the Fed's done a good job. Remember, as recently as early August, when the market kind of hit a air pocket, there were cries from a lot of influential market observers calling for an emergency interim meeting and substantial 100 basis point rate cut by the Federal Reserve. I think, to the Fed's credit, they did not do an emergency cut. I think that would have sent um, the wrong message. They waited till their normal September meeting. They did cut a big cut, 50 basis points, beginning to message that they may pause now. So I think, as always, it's data dependent. But I think we're at the camp that the Fed has generally done the right thing.
Yeah, no, I think that's exactly right. Now circumstances have changed for them, perhaps a little bit differently than what they would have projected for 25. And that's one thing that really changed around the market is when you look at what the market was pricing in for the number of Fed cuts, at one point that was 9 cuts in totality. Now, as we look out towards the end of the year, there might be one more cut and then done. And that's going to carry its own set of implications.
Yeah, and I think that's suggestive of an economy that how long have we heard
Mhm.
about the soft landing, the hard landing, the coming recession? It hasn't happened, and I think the backing off of multiple expected further cuts is just indicative of an economy that's generally doing well, a labor market that's generally doing well.
Yeah.
So I think there's a lot of tailwinds.
So thinking about portfolios for this year, then what might be on the horizon? We've all had these conversations internally around stock markets being influenced by artificial intelligence, bond markets being influenced by Fed policy. There's a lot to discuss on the portfolio side.
Yeah, I mean, let's just talk equity markets. I mean, equity markets right now, if you're looking at our expectations, they are lower now than they were probably 2 years ago. It's what happens when you have 2 consecutive 20-plus year markets, is that the valuations get a little frothy, and we've seen that. So that obviously brings that range of outcome to the downside there. But on the fixed income front, we've been saying it for a while. I mean, when you have 2 years of 25-plus equities and bonds are giving you very low single digits, some may be struggling to look. It's like, why am I doing fixed income? The reality is the rates are still higher. We're now picking up a reasonable amount of yield over cash if you're looking at a diversified fixed income portfolio. So don't forget those bonds. That carry is there. That carry is still as high as it's been for decades. So,
And if you want to take a little more, stay in fixed income, take a little more credit risk, you can easily contemplate portfolios of 7-8% return in fixed income, which begin to look fairly favorable versus some of the equity expectations. So with that, thank you, gentlemen. As always, appreciate your attention. See you next time. Thank you very much.